We told you what are active and passive funds. Active funds are managed by fund managers, while passive funds follow their benchmark indices. But what are quant funds? Should one consider investing in them over traditional funds? Let's find that out from Feroz Aziz, Deputy CEO, Anand Rathi Private Wealth. Feroz, good evening. Welcome to the show. So we've had this conversation earlier about active and passive, but then looking at the trend that's catching up in India, active, a lot of people are really aware of this, but then passive and especially quant funds, I mean, that's one category that's also becoming investors' favorite. It's taking place in their portfolio. Explain us what is quant strategy and what are quant funds?
Kavita, quant funds, as the name suggests, they use a quantitative method for decision making. That's why they called quant funds. Quite a few times, or in an active fund, a fund manager has a lot of discretion in terms of saying yes to an idea and no to an idea. How does an active fund management team work is analysts identify a universe of approved stocks. The fund manager or a committee decides which stock to buy, which stock to sell, and at what quantum. That's the process of an actively managed fund. But a quant fund actually deliberates on a formula which is triggered by some degree of mathematics, and the formula is back tested. And if the formula actually has the capability to produce extra result, then a Nifty, for example, then it becomes a quantitative formula on the basis of which decisions of that specific fund will be made in the future. For example, if there is a model which says if you look at the PE, the ROE, the price to book of a stock, the debt equity ratio, and then choose a stock, then the formula is actually applied on the entire universe, and a few stocks are chosen to decide whether you have to buy or sell. That's how conceptually, algorithmically, how a quant fund tries to operate and makes decision making more mathematical or mechanical.
But then, Feroz, tell me one thing. Are there different strategies within this quant category also? What kind of strategies fund managers usually apply to their portfolio and their investment?
See, mathematics is a very vast subject. Quant as a subject, quant as a name suggests that you are using mathematics for decision making.
Sure.
Now, there are several different methods of quantitatively creating portfolios. Now, what are the ones which have found flavor and launched in the current market situation, and it's in the process of its evolution, is to have one factor. Those are called single factor ones. There are some which have multiple factors, which in collaboration try and help the portfolio creation. So it's single factor or multi-factor. That's the current status of affairs. But in the next few years, will there be evolution to what kind of algorithms can be returned for decision making? The answer is we might still be scratching the surface. So as of now, you have a single factor or a multi-factor quant model algorithms which help decision making. Now, tomorrow, if you look at hedge funds use several algorithms for decision making to eliminate human judgment and for the capability of being able to look at multiple data points, which is humanly not possible in a fraction of a second.
About algorithms, tell me one thing. If one really wants to understand, or based on this kind of investment style or strategy, if really one wants to do a research based on the same style and go back in the history, how back can you go and track an investment based on these investment styles?
Kavita, in fact, you can go back test till the point at which you have data. Like, for example, 1990 is when Nifty started. So you can, if you Nifty is your base, and if you're looking at each individual constituents become difficult to backtest because Nifty had different 50 constituents when it was created. Practically most or at least 50-60% of the stocks would have changed in a 30-32 year period. So if you want to look at Sensex, you can look at it from 1987, which was the day when it was launched, year when it was launched. It was also rebased to 1979. So coming back to your point, you can backtest it for 20-30 years in India because that's the evolution of the capital market in India. Kavita, I would also want to touch upon in 30 seconds that statistics and finance is such an evolved subject that you can also front test your models using simulators, which is called a Monte Carlo simulator, which is one of the most popular simulator, which helps you simulate the outcomes in the next 50 years as well. And that Monte Carlo simulator, which I'm alluding to, is used in several other industries, but was invented for the purpose of finance and investing.
How does the international market look at quant investment style?
See, the quant investment style in the international market, if you look at the most commonly used nomenclatures in that business, is smart beta strategies, risk premia strategy. These are nomenclatures which are used, which help define what kind of outcomes those statistical factors are wanting to bring out. So, smart beta is a very popular strategy globally, and risk premia strategy is something which, as themes, operate in the quant space globally.
Just like active or passive, any type of investor can opt for active for quant funds.
Yes, Kavita, any investor can opt for it, but I personally think Indian investors are so non-mathematical in their decision making that they don't check anything and they conclude. Now, for example, like you said, people are running to buy themselves passive funds. That is the trend, but is that the mathematical right decision to do? To my mind, no. If you look at mathematics, you see that the 147 active fund managers, out of that, 65% of them have beaten Nifty in their respective funds, but still people want to buy passive and make zero alpha. It doesn't mean that if the herd is doing it, it is correct. So I generally get worried for Indian investors because people conclude very easily what is right, what is wrong, without actually checking the second decimal mathematics, which requires a lot of effort. And that's where the advisor should guide people in the right direction rather than the easy direction.
Also, Feroz, because there's so much of responsibility analysis and algorithm study that goes into a fund manager's role, are quant funds expensive?
No, I don't think they're expensive. Are they relatively cheaper? To my mind, marginally cheaper,
Okay.
because a human quant model needs to be established once. You don't have to pay a salary or a royalty to somebody on a monthly or a yearly basis. So they are supposed to be marginally cheaper. But it's time will say, as this becomes an important category, how directionally those differential costs pan out.
Right. But one can definitely not begin their investment journey with a quant fund, right? You should just stay away from it.
No, I don't think somebody should begin their journey with a quant fund, because there's so much of finance which a person needs to understand to see
Sure.
whether the quant strategy is good. Anybody who's launching it, of course, believes it is good. You have to check whether it is good or not. So, for which you need to know some basic concepts of mathematics, like regression, for example, back testing, for example. So, not a first time investor category.
All right, quickly now, that was all about quant funds. If at all you were unaware of it or just you were tempted to invest, it will be helpful for you to understand whether you should be going for it or not now. But then we need to include some queries on our show. And Feroz, we have Jasmeet Singh Bindra for you. He says that he's 39 years old and have been investing in Nifty Index Fund for his retirement, which is after 20 years. And he's more focused on corporates rather than the return that he would earn from an investment. Now, on debt side, he says he has PPF, money market funds, FDs. Now, he's asking whether he should be booking profit, any of the index fund, or leave it as it is and add more in equities. Also, if there is a correction or crash in the market in the near future, what should be his strategy? Currently, portfolio is around 16 lakh and the profit is showing around 2 lakhs.
So I think, Kavita ji, the question of Jasmeet has quite a few suggestions which I would like to give him. Firstly, if he has a 2 lakh profit on a 16 lakh capital, then he should book his profits on a yearly basis, because you have a 1 lakh per annum exemption, per financial year exemption, to save that 10% tax of long-term capital gain. So not booking these profits and accumulating it over the years may make you pay 10% tax for something which you had an exemption on a yearly basis. So please act on that, book profits and get back to what you wish to invest. You can blow back your money in the investment anyway. So that's point one. Point two, I personally think for somebody who is 39 years old, has 20 years to invest, shunning active managed funds and just being in Nifty is a sure shot recipe to make significantly lesser value. So the schemes which, for example, Anand Rathi chose with a lot of binocular lens has generated 2-3% extra return over Nifty after cost. So why would you let that massive alpha opportunity go? That's point two. Point three, to my mind, you should include different categories of funds. So I'm going to give you five funds which I would like you to consider. Is Franklin India Blue Chip, which past performance may not be so good, but the future prospects seem bright. HDFC Flexi Cap, ICICI Focused Equity, Kotak Emerging Equity, and SBI Contra. So all five schemes from different asset management companies and different categories, which have a complementary nature to bring in some degree of risk mitigation, and a 12 to 14% expectation and 2% alpha with these five schemes is possible after the cost of a regular scheme. And if you're buying it directly, you will have almost about 2.5% potential alpha, which hopefully will transpire on a 3 to 5 year investing time frame.
All right, so that was the solution for Jasmeet on his financial portfolio, and the time is up. Feroz, thank you so much for being on the show and guiding our investors on the different parameters of investing.